All right, Dylan, can you hear me?
Yes, sir, I can. How you doing today, Dom?
I'm doing awesome, man. I know a lot of people were maybe panicking or, just dealing with all the fear factor, I guess, of what's going on in the market. But I looked at it as everything was on sale today, man. So I picked up a whole bunch of stuff.
Yeah, the valuation out of these stocks are just they're becoming absurd. So like Upstart is a good one right now. It's trading at I think it's actually less than a 10 like next 12 months price to sales ratio. And their contribution margin is about 40%. So just rough math off the top of my head, that's going to put them at I don't know, 20x forward I think that would be like EBITDA. That's kind of their version of EBITDA. But like 10 forward price to EBITDA. I mean, that's just absolutely no, sorry, 20 forward price to EBITDA. Oh my gosh, I got so many numbers coming out of my head right now.
Oh no,
But
it's
yeah,
fine, man. I mean,
I
see, and
got.
this is the crazy part. See, I gotta learn. We're all learning together, right? We're all
Yep.
learning through this process. And for anyone that follows myself or Dylan or anyone on Twitter, that matter, um, you can't predict the market. You can't call a bottom. It's really hard to do that. And if you got lucky and did it, well, good for you. It's hard to do it twice. So, for instance, I can't predict the market. You can't call a bottom. It's really hard to do that. And if you got lucky and did it, well, good for you. It's hard to do it twice. So, for instance, like I picked up Upstart at the inflection point was 180, 183 and I got at 186. It was supposed to bounce off, and that was pretty much based off the technicals. That was as low as it was going to go,
Yep.
and we're sitting here at 179 because now I thought we'd be past this, but the media does a really good job of hyping things up before evidence of anything is out there, right? So you had kind of a little perfect windstorm with what Jay Powell said. Um, and we all knew tapering had to happen eventually, right? And it still
Yep.
hasn't even officially happened. So we saw that kind of start the process of tech stocks, which granted, I mean, we needed a correction, right? Like let's be honest. I mean, it was going really high for the S&P 500. It was at 1.27% for year to date, right? So that's not normal. Investors in general should not expect that to be the norm. That is definitely not the norm. More 8 to 9% is. So correction was definitely in play and expected eventually. And then we have the Omicron data and the first person that gets it, and then now all these others are popping up, and so it'll be interesting to see in the next couple of days if the Nasdaq stocks, the tech stocks, whatever you want to call them, the stay-at-home stocks bounce back, or if this is more of a perfect storm of okay, here's the real that we were expecting, right? And that's what a lot of people are predicting around December, January, maybe even wait till February. But if you look at the historicals, we typically see something around one of those 3 months in the market. What are your take?
Well, are you talking about from like a recovery standpoint?
Yeah, I mean, just as far as like I mean, I I just wanted to pick up a lot of stuff today, so I
Yeah, we
started
got.
my first position in Tesla. I bought some Upstart, I bought, of course, Palantir, but it's really hard to catch the falling knife. But I think the one thing you can rest assured is if you bought something today, looking back or looking forward 2, 3 years from now, I think you'll be happy with what you bought today.
Yeah, well, we do got a lot of stuff to talk about today. That's for sure. But if you really zoom out and if you look what's going on, like you can tie it up into COVID. And I'm actually typing up a Substack right now to really help investors zoom out and put some perspective on things, right? Because obviously we can never tell anybody like what to do with their portfolio or anything, but if you zoom out and if you look at what's really going on, this is predominantly going to be macro driven. This is a lot of the markets overreacting and they're probably pricing in increased interest rates, right? Which obviously affects the valuations of growth stocks. And then in addition to that, too, they're also pricing in a faster taper. I think the best way to really look at this is think about somebody who drinks like 4 or 5 cups of coffee every single day for basically 2 years now. But what ends up happening is now all of a sudden you start cutting back on that coffee. Well, even though you know it's going to suck, you still have some sort of withdrawal symptoms, and that's essentially what I think that is actually going on right now in the overall markets. It's just a general like disruption in the markets when you have these contracting liquidity. The biggest problem is though is that now valuations, especially now, but now valuations are really starting to come down from a historical perspective outside of large cap stocks, which is very, very interesting. I think I ended up posting not too long ago the disparity just the difference that you actually have between large cap growth stocks and small caps, where small caps have seen what would be equivalent to a bear market from like the February top to all the way to now. I mean, I think that the drop difference is actually going to be bigger than it was in the 2008 financial crisis when it comes down to a valuation contraction perspective. So that should really put a lot of perspective on a lot of the traders who have successfully made money this year, and a lot of the investors who have been able to stomach this sort of turbulence. But really, like when you look at the big picture of things, and you do zoom out and you stay true to the valuations and the fundamentals of the business, it's very, very hard to not look forward 3 years and not be happy that you actually bought on this sort of market turbulence.
No, I would agree so much with what you just said there. And this is when having that tough stomach from a small cap perspective, right, is important. I have a significant amount of Digital Turbine today. Once again, this is not buying recommendations, this is not sales, not anything. This is just us speaking about our opinions and how we operate in the market and what companies me and Dylan value. And just what's going on in the stock market, right? Like, obviously, you guys are here for a reason because we all like talking stocks or like listening to someone talk about stocks. But with Digital Turbine going to 50 and then even sub 50, this is a company trading at, I want to say it was a price to sales of like 7 forward and a PE of very low double digits, right? Growing over 100% year over year, making acquisitions and growing gross profits too to 60%, you know, so riding a trend of CTV and advertising, everything else. It's like the institutional pileup in that stock just this past quarter was 26% added from this past quarter. Now it's 74% institutional. That stock, nowhere near that just a year ago. I remember you doing a Spaces defending that stock, saying it's so much more than a company that just preloads an app on your phone. And now you fast forward and it's just getting caught up in all of the madness, all caps. Same thing with Palantir. You know, you look at what Palantir, I mean, we broke 20 for the first time, and based off technicals, who knows? Maybe we go a little lower. And if we do, I'll be adding more. Officially my number one position, and so excited that was able to take it from 0 to number 1 and 6 with all the paychecks and balancing a portfolio. But I think this is really when it comes down to doing your due diligence, knowing how to research a company, making sure your thesis is intact. All right, double check it, right? Is it unjustly going down, or does it really deserve to go down? Like you look at Mercado Libre. You hold that one?
So currently I bought it right at 12.50, and then I ended up selling it today to reallocate a lot of that buying power to short ARK's ETF. And the reason why I'm doing that is, and I'll talk about trading here in a second. Let's keep it on the topic of investing, but the MELI valuation in general is absolutely nuts.
Are you saying nuts as in undervalued, like as far as like a great sale, or that it's overvalued and should go lower?
It's a great sale. It's a great sale as it is right now, because essentially what's going on here in the markets is that it doesn't matter what the valuation is. And the markets do this on both an up and a down perspective. And I think 2021 has been the worst year, where you see stocks that can run way past their fundamentals. Like Upstart is a great example. It ran way past it. Cloudflare, ticker symbol NET. Then you also have like Asana that did the same thing. So you got a lot of these growth stocks out there run way past their fundamentals, and now they're correcting, right? And then MELI in this particular case, and you'll see this with like Roku, and then you also see this with, now it's Upstart, but you see this with a lot of stocks too, that it just doesn't matter what their valuation is anymore. It doesn't matter what the business fundamentals are. If it's a growth stock, it's going to sell, because they're all being clumped together right now. And I do think that that's what's going on with MELI, is that right now it just has a lot of momentum downwards. And for really, I think I heard somebody not too long ago, or I read somewhere on Twitter, that it had something to do with their lending, which is why they ended up doing a capital raise not too long ago. But you can't help but stop and think to yourself, like, okay, MELI's trading underneath the 10x forward price to sales. They're a profitable company. They're still growing. I think they actually have posted well over 70% growth this latest quarter. And it really seems to
It's
be
actually over 100% year-over-year growth still.
okay. And those are tough comps. So those are really tough comps. And so they're growing well over 100% a year, and they're penetrating an area that is a rapidly growing total addressable market. Latin America, is going to be one of the fastest growing e-commerce areas. I don't know what you really want to call it. It's like the continents, one of the fastest growing continents in the world as far as when it comes down to e-commerce growth. When it comes down to like a total addressable market perspective, so is that it has the highest CAGR, and then you can't help but believe that MELI is going to be a major beneficiary of that. So it's right there at the top of my growth, right there at the top of my watch list. I just want this market to chill out for 2 seconds, and then I can actually cover a lot of the short positions that I have, and then really load the boat.
Yeah, see, and we can definitely get to trading because that'll be for sure your niche and area of expertise there when you talk about swing trading and all of that. I know that you have a long-term in invested portfolio as well, a portion of it. So maybe what we'll do is the format is let's just keep talking about this week. I'd like to see if we can go maybe an hour. I know that if that's too long, people can definitely drop off. This will be recorded and redistributed, but we'll talk about this week, talk about some of the other stocks, and then we can really talk about where we're headed for next year and trading and kind of dovetail into that. So just continuing on with MELI really quick, I'm just looking at to your point, the comment of fundamentals. You're so spot on in that fundamentals are not being looked at right now. And it goes back to that famous Warren Buffett quote. The stock market is a voting machine up front, but in the end, years down the road, if that company has survived, it will be part of that weighing machine, right? And you look at it, and they did just become profitable. They did $6.2 billion in revenue last year. They're growing their gross margins. They're modeling their business model both after PayPal and Amazon, right? Like if anyone knows the MELI story, the founder really modeled after eBay and kind of the PayPal style of e-commerce and understanding what the challenges were with that area being very unbanked. And so now we see digital wallets. Emerging companies and continents are skipping what the U.S. does with banks, and we're kind of honestly, and the fact that we're trying to get to more of a digital wallet type of environment because it is so much easier. It's easier just to send your friend a Venmo, when you need something or anything like that. No, who wants to go to a bank, right? And what I love about their analyst report when they were talking about how they're helping their small businesses and their entrepreneurs, they're teaching them how to take pictures of items correctly so they sell well. They're training them on building websites and all of these different things. They're capturing a lot of what Shopify does from we care about our customer, our entrepreneurs. We want the medium and small business companies to succeed in Latin America, right? And we also see that with C Limited. And so they've learned from some of the mistakes I think that Amazon has done with just blowing the competition out. If you have a great idea, great product, we'll mimic it, sell it half off, and we'll take that business, right? But I just think when you look at overall, they're growing earnings at 50% annually. They're growing revenues still 28% annually. And their return on equity in the last 3 years, for the next 3 years, is going to be projected at 64%. That's good for shareholders. The industry is at 20% when you look at return on equity, right? So I could easily see them doing a stock split just to psychologically drive the stock even higher, just like NVIDIA did, Tesla, etc. But coming full circle is just that now is the time to really make sure you understand, even if you don't get in at the bottom, but this is a time where quality companies will ultimately outlast and endure these tough seasons. What's one company that you were looking at this week, Dylan?
Yeah, so I think it's important to really define what quality company is, and I think that this is a lesson that I've learned over the years, and that is that when a company is not profitable, you run a higher risk of the stock price not recovering after a correction or a crash. And it is important to know that Mercado Libre is profitable and they can turn on their profit engine whenever they feel like it. For me, I'm really looking at DLocal. I think that I've really averaged down on my position, and that is going to be one of my biggest bag holds, believe it or not, because I think my average cost basis right now is like 44 or 45. And it's currently trading at like $32 or $33 per share. And I don't mind it. I don't mind it at all because the stock in general, the business in general is just such a fantastic business with 40% EBITDA margins, well over 100% year over year growth, 170% NRR or net revenue retention. So, I mean, DLocal has definitely got to be one that's on my radar from just a general profit and growth monster. I've also been adding Monday. I think that this is a stock that's recently just came on FinTwit's radar. Monday is going to be, so let me clarify the difference between Monday and like Asana. So Asana is going to be a lot more on the workplace collaboration. So they really help out with like task management and things like that. Where Monday is new, they're pioneering a new type of software. And what they're trying to do is they're trying to take like a modular approach where they can essentially give you the building block, give you as somebody who doesn't necessarily know tech that well, they give you the building blocks to create your own CRM, to create your own whatever it might end up being, right? So I know that they do CRM, they could do any sort of like project management or task management or like DevOps management. So it's a little bit, it's competing a lot with these other guys like GitLab as well. So Monday, in addition to this, Monday is also growing. I think it was 90%, well over 90% year over year in the latest quarterly report. They're guiding for well over 85% year over year growth on a full year basis. And the thing that I like the most about it is that it's running 90% gross margins. And then it's also operating cash flow positive. You don't find that in the SaaS world. So you don't necessarily find a company that is that disruptive, that is operating profitably and has those kind of margins. So later on down the road, like let's say 3 years, right? When we think 3 years out, we can't help but know that this is going to end up becoming a multi-bagger, assuming that they have successful management execution. But those are two stocks right now that I'm thinking of is DLocal and Monday.
Yeah, I remember you telling me about DLocal, and I've been diving in deeper to that one. Familiar with all the ads that Monday provides on YouTube and elsewhere, but they are, like you said, they're projected still to grow at 30% per year, year over year. And just checking out here, obviously they're not profitable, but no debt. That's what I look for, right? So like I like this concept of let's talk about, and I added Chet too, so feel free, Chet, when you want to speak here as well, about what is a quality company to us, right? I think that's a very important topic to cover for investors. For me, things that I look for, I would say 90% of my portfolio is founder led, right? Because I'm a firm believer of when you invest in a company, you're really investing in people. Like let's cut through all the things that we're looking at, and we're investing in that person and their vision and the execution and the team that they build around. And statistically showing when you have founder-led companies, they outperform and they also stay at those companies a lot longer. I think I heard on a podcast this week that the average CEO stays at a company for like 5 to 6 years. But if you get a CEO that stays over 10 years, the stock return is drastically different. What are your thoughts around that, Dylan?
Man, I like that you bring that up. And the reason why I say that is that I just released a Substack not too long ago on a company called Samsara, ticker symbol IoT. They're going to IPO very, very soon. And I love the business model. Essentially, what they're doing is they give you IoT hardware, right? So they give you hardware devices to integrate within your supply chain. This could be like trucking. And this is going to be what a lot of these CIOs and emerging CIOs in these legacy supply chain businesses have really looked for. And this is going to be I remember I used to work at Gartner, and I used to work with a lot of these manufacturing CIOs, and they've always talked about how they wanted to integrate IoT. Now that was 3 or 4 years ago. And now I can really see that Samsara is really creating a need in this market to be able to record a lot of those logistics and really integrate data and analytics. And now, yes, Samsara is a very compelling business, but the number one thing I think about is what is the CEO's long-term vision? Because yeah, the gross margins look great. Yeah, they're going to be flush with capital after they IPO. Everything should work out with the business, but the business will not yield great returns over time if you don't have a smart CEO with a long-term vision. What are you thinking, Chet?
Yeah, I fall in the same camp as y'all about founder-led businesses. So I believe the main principle behind that for me is like a concept called skin in the game. When you have your own money and your own life, kind of your own net worth, your own house, and everything invested in your own company, you're really bound to make good decisions, and you are bound to not risk your company at all because it's your life. It's something you're building. It's your baby. You're going to build for probably decades, and you don't want to lose that. So I totally believe in that concept, and I believe like 90 to 95% of the stocks in my portfolio are founder-led businesses, and I prefer them. Overall, I think founder-led is good, but you have to also look at how much of the ownership is actually, how much of the equity ownership is actually owned by the founder itself or a group of founders. So
Bingo.
I need at least 10%, and I actually invest in small caps, so small cap growth investments. Usually I look for more than 20% because those are really small equity values anyways. But for bigger companies, I would say like if any founder has a net worth of more than 500 million, and even if it amounts to like not like 10% or 5%, I may give it a pass. Now, the other thing I couple with the founders is the culture and how they lead. I think that also plays a lot in my investment strategy. So I'm like a software engineer by profession, and I work at a B2B software company. So what I think about is like, hey, is this investment or is this business that I'm looking at is someplace where I could go and work tomorrow? Will I be passionate about their mission? Will I go and be proud of myself working there, build software that's going to impact a lot of people? Will the company treat me good? Are the people working there really great peers and that will like help you grow and learn with the company itself? So those are some things that are like pure quality, not numbers. And if you know that if some business is of that quality, then you're going to have much more success with it. I think the same concept was like, there is a story when Google came to IPO, before or after, I think probably before they came to IPO, they had met up with Warren and Berkshire and wanted to know what was the secret for a success over the long period of time. So at that time, I think Warren has shared stories about culture being one of the prime determinants of success in long term. And that's why Google founders, when they wanted to come public and they wanted to scale their business like crazy, they knew that they had to keep their culture alive. Otherwise, it wouldn't be like a long-term success. Now, you get it, obviously, it's going to get watered down. They have 100,000 employees and stuff like that. But I think initial 10, 20 years, it helped them a lot to have culture. That was their competitive advantage. It's because they could get the cream of the crop, like the cream talent from software engineering to work for them. And once you have the best engineers in the world, you can basically go and build out any product you want.
No, you're very, very spot on with what you just said there. And I would like to highlight some of the key things you said there with it's very important to understand what the employee satisfaction is. As much as the external NPS Net Promoter Score is for customers, the internal promoter score of what employees are saying about the CEO and about the culture, to what you were saying, is so critical because it is really those top 1% talented people, especially in the software world, that make the difference for those new products and those innovations and drive the company forward. That's why companies pay so much for developers and engineers. So when you look at Glassdoor and you look at a company like NVIDIA that has literally been in the top 10 for best place to work in for the last decade, and you look at Jensen Huang being a top rated CEO, even person of the year in Time magazine last year, that means a lot. I would say even more than what their earnings beat was for the quarter or their cash flows, right? Because that tells me they have something that is keeping people around. It also has people excited to be at work. It doesn't feel like work. And when you can get a whole company to drive like that, to a mission and a vision, that's when you talk about generational companies. So I think you're definitely spot on. And if you look at some of the holdings that we tweeted about earlier today, you look at Mercado Libre, you look at C Limited with Forrest Lee, you look at Palantir, you look at Net. Net's a great example of I finally got to really make a meaningful contribution to my portfolio on Net. And I didn't catch the bottom, but regardless, I believe in Matthew Prince. I believe in the culture he's built. I believe in his drive to stick it to Amazon and take away egress and ingress fees. And the business model too is so important when we talk about quality companies. Let's kind of open it up and let's roundtable it on business models. So I'll start with Net. Their business model is so brilliant in that they have these freemium models for their products. So there's a lot of great products you can get for free with them, and then they will use that free customer base, which is like 200,000 plus customers, and they will use them as their beta for new products. So they'll get customer feedback so much faster and be able to make tweaks and other things before general release so that they can deliver a product that makes sense for the customer and helps drive that net revenue retention rate. I think that's very unique. I have not seen that in a lot of different companies at that level of scale. And when you look at their website and you look at their portfolio, you see all the different new products. It's impressive that they're not only delivering those products, but their net revenue retention rate and expansion in revenues and margins are supporting that customers are actually wanting to buy these. So Chet or Dylan, any comments on unique business models that you would define as, hey, this makes it a quality business because the business model is really unique and supports the growth.
Yeah, dude. I think that Pubmatic is just not talked about enough. So Pubmatic is going to be one of those business models that really truly are unique, and I think it's very interesting to see that Magnite is going to be one of their biggest. So let me just provide a brief overview of exactly what Pubmatic is. It's going to be a supply side advertising company. So there's going to be demand side, and you got supply side. Supply side essentially represents people who host the space. So
Long being a top rated CEO, even person of the year in Time magazine last year, that means a lot. I would say even more than what their earnings beat was for the quarter or their cash flows, right? Because that tells me they have something that is keeping people around. It also has people excited to be at work. It doesn't feel like work. And when you can get a whole company to drive like that to a mission and a vision, that's when you talk about generational companies. So I think you're definitely spot on. And if you look at some of the holdings that we tweeted about earlier today, you look at Mercado Libre, you look at C Limited with Forrest Lee, you look at Palantir, you look at Net. Net's a great example of I finally got to really make a meaningful contribution to my portfolio on Net. And I didn't catch the bottom, but regardless, I believe in Matthew Prince. I believe in the culture he's built. I believe in his drive to stick it to Amazon and take away egress and ingress fees. And the business model too is so important when we talk about quality companies. Let's kind of open it up and let's roundtable it on business models. So I'll start with Net. Their business model is so brilliant in that they have these freemium models for their products. So there's a lot of great products you can get for free with them, and then they will use that free customer base, which is like 200,000 plus customers, and they will use them as their beta for new products. So they'll get customer feedback so much faster and be able to make tweaks and other things before general release so that they can deliver a product that makes sense for the customer and helps drive that net revenue retention rate. I think that's very unique. I have not seen that in a lot of different companies at that level of scale. And when you look at their website and you look at their portfolio, you see all the different new products. It's impressive that they're not only delivering those products, but their net revenue retention rate and expansion in revenues and margins are supporting that customers are actually wanting to buy these. So Chet or Dylan, any comments on unique business models that you would define as, hey, this makes it a quality business because the business model is really unique and supports the growth.
yeah, dude. I think that Pubmatic is just not talked about enough. So Pubmatic is going to be one of those business models that really truly are unique, and I think it's very interesting to see that Magnite is going to be one of their biggest. So let me just provide a brief overview of exactly what Pubmatic is. It's going to be a supply side advertising company. So there's going to be demand side, and you got supply side. Supply side essentially represents people who host the space. So like think about Fubo, their streaming service. They need somebody who represents them to essentially advertise the space and content that they have available. And then they chose Magnite for them, but they need a supply side advertiser to do it. Demand side, like the trade desk, they essentially partner with CMO or the chief marketing officer. And they go out there and they try to find space for them to allocate their ad budget to. So Pubmatic is going to be a supply side advertiser, and they do compete with Magnite. But the thing that makes them the most unique is that they run an infrastructure first approach to their advertising model. This is going to be a lot different than their biggest competitor, Magnite, and it's actually being reflected in the valuation today. I think back in April, I ended up making a YouTube video saying Pubmatic's better than Magnite. Man, oh man, did I get some flack for that one. That was that was funny, but it's coming to fruition. And the reason why is that it creates like this flywheel approach. So this infrastructure first approach that they actually have to their business model, essentially what this has done is that it allows them to innovate faster than their competition. So they own their own cloud infrastructure. I think that's important to emphasize, is the cloud first approach. So they own their own cloud infrastructure, which means that they don't have to host their business AWS or Google or Microsoft, right? So they have their own cloud infrastructure, which allows them to innovate faster and also drives better margins and also has better pricing. So pricing power and also transparency for their customers. So what ends up happening is, yes, the digital advertising space is rapidly innovating, and it's growing very, very quick. And it's also consolidating too. So Pubmatic was very smart throughout their very early stages of their business, and they did invest into this infrastructure. And they said, you know what, later on the road, the industry is going to consolidate, and there's probably going to be things like, third-party cookies are going to end up going away. And they invested into that with their infrastructure years ago, and they got ahead of the curve, and they're doing it still to this day. And then when they actually appeal to those customers and are actually able to fulfill their needs, they can actually offer a lower price than Magnite would or a lot of these other buy-side advertising companies would, because they own their own infrastructure. They don't have to give a portion of their margin to, like, let's say AWS, Google, or Microsoft. So then they can actually have this pricing power. And then in turn, they also run 70% plus gross margins and then 30% plus EBITDA, which means they have a lot more money to continue to reinvest back into the business, to continue to innovate their platform faster than the rest of their competition. So in turn, you do get this flywheel approach, because you have happy customers who are getting a lower price, but you're still staying profitable, and you're taking all those profits and reinvesting back into the business, thus innovating faster, thus making your customers happy. So Pubmatic is going to be one of those companies out there that it's still slept on. And I like it underneath $40 per share. But it's still slept on to this day, and it just really shouldn't be anymore. They've killed every single earnings call that they've had, growing 50% plus year over year, major beneficiary of industry consolidation. Yeah, it should really be looked at.
I had a few thoughts about what Dominic and Dylan said. I could actually go on and talk about like ad ecosystem for an hour, so I'm just going to avoid that. But really good call out on Pubmatic. I haven't looked at them in detail yet, but I'll sure do a deep dive on them soon enough. But talking about innovative business models, a recent innovative business model that I've been kind of supporting is in the healthcare space. So generally, if you associate your experience with healthcare, it's usually like really bad, really slow, really old experience that was being recently disrupted by like telehealth, Now, there is a company out there, its ticker symbol is HIMS, HIMS. So what they are doing is they are disrupting this traditional healthcare model where it was primarily like insurance-based, mafia kind of healthcare system to like a consumer-focused healthcare system where, like, suppose if I sign up with HIMS, I could get all my primary care or like basic care done through the telehealth. And if I don't need to see a doctor, I don't need to go and see a doctor. So what they are doing is they are doing a full vertical integration on the healthcare side by providing the telehealth system, which has a really low cost. It's a really consumer-focused business, so they have low marketing spend to gain a lot of customers. And what they do with those customers is that they try and sell them services which are incredibly cheap due to their vertical integration. For example, like if you have like hair problems, your hair is dropping off, something like that, and you need medication for that. So you wouldn't go through the traditional channels for that. It's kind of what I would say. Sometimes it feels like shameful to talk about these things with your doctor. But with HIMS, it's like a really good experience. So they started there, and now they are going in all the verticals of healthcare, and their vertical integration does not include only a consumer-focused telehealth system, a really good experience through primary physicians. It also includes the drug side, which is like the medicines. So they have their own pharmacies across US and UK, where they are producing their own drugs and they are supplying them uh, on a 2-day delivery basis to everyone who orders it through their app. And they recently launched a partnership with Uber where you can get all the medicines on demand. So if you have high order values, you can basically order your medicines on demand from Uber for HIMS. And they have a bunch of partnerships for their nutrition, some other products that are being sold through like Vitamin Shoppe and other partnerships. I think they had a partnership with Walgreens or CVS, one of them. So yeah, I think what they are doing is they have really high healthcare gross margins. They are disrupting the entire, I call it value chain. Value chain is like basically if you have 10 people between you and the doctor, they are removing all those touch points. And between you and getting the medicines, if there were suppose 10 more people, that would take a cut. They are removing that too. So what the result is that you get an incredibly cheap experience from HIMS, which is basically value. And what they do is they are providing low cost to consumer at a large scale because it's not a traditional platform. It's entirely digital platform. So they can scale their healthcare services to millions of users without much effort. So that's a disruptive model that I've been supporting. The stock is beaten as hell, you know. I've lost a lot of money on the stock, but that doesn't bother me because I'm in the stock for like 5-10 years. It just doesn't matter to me. It's like buying Amazon early when Amazon was driving transition in a vertical. So obviously the stock gets beaten down a lot, you know, initially.
So this is one of the reasons why I love FinTwit. Here it is, a stock that I had a misconception about their business model and that they only had really one product because I hadn't done my due diligence yet. It hasn't really been a space that I'm very interested in. But then learning more and hearing you talk about it, that there are things that I'm interested in. It does seem there's more digital aspects of health and technology. And I then go in and I say, okay, well, let's see just, before really.
Which is basically value. And what they do is they are providing low cost to consumer at a large scale because it's not a traditional platform. It's entirely digital platform. So they can scale their healthcare services to millions of users without much effort. So that's a disruptive model that I've been supporting. The stock is beaten as hell, you know. I've lost a lot of money on the stock, but that doesn't bother me because I'm in the stock for like 5-10 years. It just doesn't matter to me. It's like buying Amazon early when Amazon was driving transition in a vertical. So obviously the stock gets beaten down a lot, you know, initially.
So this is one of the reasons why I love FinTwit. Here it is, a stock that I had a misconception about their business model and that they only had really one product because I hadn't done my due diligence yet. It hasn't really been a space that I'm very interested in. But then learning more and hearing you talk about it, that there are things that I'm interested in. It does seem there's more digital aspects of health and technology. And I then go in and I say, okay, well, let's see just, before really deep diving, like I would want to hear the CEO speak and really understand the culture of the company and things of that nature. But just from a pique my interest, right? Let's look at the numbers. Everything you said is spot on. All the articles talk overbeaten it is, how it's 71% undervalue. You look at the price to sales ratio is only 5. Gross margins, I always look for high gross margins. I think every one of us will agree when we say quality business, we look for high gross margins and high net profit if they are profitable, because that allows you to reinvest in the business. So 76% gross margins, 0 debt. I always like to look for companies with very low debt because in times like this, when we're seeing the market get a little irrational, you want to make sure that they're going to be able to weather the storm. So we then scroll down here and I'm looking at price to book ratio is right in line of, more assets than liabilities at 3.8. Industry average is 2.7. They're projected to grow earnings for 23% for the next 3 years. Revenue growth of almost 30%. Those are really healthy revenue growths, especially for the nature of this business. I think people sometimes get lost in hearing, revenue growths of 100%, and it may be e-commerce or it may be Snowflake, and these are rarities when you hear about triple-digit growth, right? And so 30% year-over-year growth is very good if you can withstand and hold that, right? And then you look here, they have plenty of cash on hand. So you've really intrigued me, especially the fact that 70% undervalued right now, and they have enough cash runway based on their current cash flow to be fully functional for the next 3 years. So thank you for sharing that stock, Chet. Avid, I want to give you a chance. I know you requested to speaker, and then after this, for the next 20 minutes, we'll just do Q&A. So you're on.
Hey, what's up? Thanks for having this space. I just wanted to add a little bit to the conversation of being founder led. First, I want to agree that that's a big thing for me. But there's one thing that I would definitely like. It would make me definitely throw like founder led out the window if that was the case, and it's having a compensation packet similar to the one that Elon Musk had, because that's like Chet said, I think that just shows like huge skin in the game. And I wish more companies had that, especially like non-founder led companies. And I'm pretty sure most people know, but for those that don't know, the compensation packet for Elon Musk was something that he like along the lines of a packet where he would only get like compensated if the company and the stock reached certain milestones. And yeah, of course he did. And yeah, that just to me just shows like huge commitment, huge skin in the game. And if Dylan or Dominic or Chet knows other companies with similar compensation package for their CEOs, I would love to hear about them.
Yeah, no, that's a great point, Avid. One of and it really opens up a conversation on too, what we encourage investors to do is read the 10K, read the proxy statement, read more than just what you see on FinTwit, right? Dig into the financials and the investor presentations and everything a company puts out there, because that is earned conviction. You can't borrow it from Chet, myself, anybody. You can't buy it from a stock service. You can get intrigued. You can have your ideas agreed upon or, kind of validated. But until you understand, how does the company make money? How are they compensated from a leadership perspective? What is the culture? What is the differentiator, and what are they disrupting? You really can't stomach a 70% drop and say, you know what, I'm going to add more. That is something that you really want to do, so that way you can know that I'm prepared to lose this money on this company because I'm well diversified. I believe in the leadership. I believe in the company. I believe in the thesis, and we're going to see what happens. Another company that I think has a lot of leadership with shares. We obviously know our favorite, 3 of the 4 speakers. I don't know, Chet, if you have any Palantir, but Palantir is one where people misunderstand that the leadership team had to exercise and sell the shares, or else they would have taxable issues going on, and that they've been at the company for 17, 18 years, and they had not received compensation for all the things that they've built. So if you were to be in those shoes of that CEO, I think you would do the same thing. And we just saw Elon do it. And here's the crazy part. Elon sells 10 billion of stock, and the stock goes up. Right? I've never seen that in my life. At that point, that's when I started I opened my position on Tesla today, because I was just like, I don't care what point I get in. I don't care what the price is. I know, my conviction long term, if I hold this for 20 years, I should be good. And I just want to start building, right? I want to be a part of a shareholder of Elon and his crew, right? These are the leaders, as Chet said, of companies that I would be proud to say I worked there. I would want to work for Jensen Huang or Alex Karp or Elon Musk. So I look at those kinds of things, because when the dips happen, it's easier to deal with, and your confidence is there, and you're able to add to those positions in days like today. So Chet, any comments on that?
Yeah, Palantir has been like really close to my heart for a long time. I have like researched the company a lot. Unfortunately, I don't have a position now, but I think in December, in a couple of weeks, I'll get my paycheck and stuff. So I'll have a position by that time. So the way to understand Palantir is like, think of the entire Palantir team as a cornered resource. A cornered resource is a group of individuals, or suppose like if you want to think about it in atoms, if you had a mine next to your house and you own the land next to it, so that means that you can mine it forever and make money off of it. Similarly, for human capital, the top 1% of the tech community or the tech developers and the business people who want to work in top companies can't even make into Palantir. Palantir is really selective about picking people. They probably, like, I'm a software engineer. If I apply to Palantir, I'm sure I'm going to get rejected. You can't go to Palantir from outside. They have to select you. It's a very closed culture that is very tightly knit. So Palantir's main competitive advantage is their initial founders and investors, basically like Thiel, and how he has laid down the entire company. So, I mean, I'm sure everyone knows about their products and stuff like that, but I look at more quality aspects. And in that, I think that counts a lot. And the second part over there is that you have a legendary, I would say downright legendary investor on your board, Peter Thiel. If you look at all the SPAC investments that they have made, I think they have made about 14 or 15. Out of those, I own at least 5 because I can see 5 years, 10 years down the line, they are going to be like probably they are going after huge markets, and out of those 10 or 15, I think at least 4 or 5 would going to be like at least 10 times or 100 times their value in like 10 years. It's because they are going after trillions of dollars of TAMs and are counter positioned in disruptive categories with disruptive business models, and no one sees them coming. And they are backed by these huge investors. So I think from qualitative perspective, I think Palantir is truly unique. It's something that I would own. I'm more of a small cap dabbler, so I own limited mid cap stocks and large cap stocks. So I think I only have a few of them, and they probably are like 10% of my portfolio. Most of my portfolio is like, I would say 80 to 90% is small caps, growth stocks, which get like, I have bled a lot in this past year, but all these are long time bets, you know, I can't judge myself. I have a buffer of at least 3 years before I sell a small cap stock. So yeah, but in any case, about Palantir, yeah, their culture, their leaders, their founders, their investor, everyone is a super high quality cornered resource, which you can't get, you know. Give Alex Karp like $10 billion and try and hire him. He's going to probably say no.
No, I definitely agree with you there. And going back to that culture, going back to, would you want to work there? Would you want to say, hey, this is my jersey. I want to wear, this is my football team that I want to invest in. And when you've done all those checks, you've done the due diligence, you've seen the CEO presentations, you've listened to people that have worked there on Twitter or other means, it helps with conviction. So we're going to just open it up with questions for the last 12 minutes. So if you want to just request a speaker, we'll let you jump on here and do our best to answer any questions you guys have.
Hey, Dom, I had to go, but thanks for everyone here, Dylan, Dom, Chet, for having the space. I'll see you guys.
All right, thank you. All right, I think we have someone here who's requested. At GSPO14. I think you're on mute. And we got another one, Alpha Extreme. So while GFO gets taken care of there, Alpha, are you there? You're on mute too.
Hey Dom, hey Dylan, another great spaces. Love your ideas and the way you share your knowledge. Pretty remarkable. I just want to know, what are your thoughts on current market sell-off, and what do you think we are headed towards from the macro perspective? Considering there is too much variation between the S&P index and all the growth stocks, I have been holding off on a lot of our names, but seems like it's hard to hold off and want to make a big entry on from whatever cash I've collected over the year. So just want to know your thoughts on that.
No, it's a great one, and thank you for joining the spaces today. I'll start and then pass it to Dylan and Chet here, because I think one thing you'll know about me and Dylan is that we post all of our successes, but also all of our failures on FinTwit and our YouTube channel and our podcast. you know, we're all just here trying to learn, right? Provide for our families. I got 2 little kids and a wife, and retirement for me one day is just to talk stocks and actually have a living for it, you know. Um, so one of the things that I'm learning as a new investor, you know, I've done index funds for 11 years and done individual stocks coming up on 3 years in February, is I get anxious. I get excited when I see something that I have total conviction in, I've done the homework, and it gets on sale like it was today. Um, I have a tough time doing dollar cost averaging. I psychologically feel like, oh, I'm getting in at the lowest price. Like this is just such a stupid price. I'm gonna put $1,000, you know, on Mercado Libre, and then it goes lower. You have that buyer's remorse. So that happens throughout today. That happened throughout today, and I loaded the boat on several ones. And of course, then Omicron fears got really exacerbated at the end of the hours, and things really, you saw, to your point, you saw the S&P flip, you saw the Nasdaq flip, and then it just mass sell off. You can't beat yourself up about that. You can't, you know, yeah, you learn from it. You try to do DCA, and instead of putting, you know, $1,000, you put 250 or 500. I'm going to spread it out. That's something I struggle with, and to this day, you know, need to do a better job of. But Dylan, Chet, maybe you can speak on this as well.
Yeah, I'll stick with the macro perspective here. So, by no means am I going to be an economist, right? But I do have some thoughts around what's going on as far as like the interest rates and the Fed tapering, and really how to like handle this, right? So I'm a big proponent of price action. And the reason why I'm a big proponent of price action in the first place is that we don't know what we don't know. But institutions are going to be a lot smarter than us. And that's one of the biggest things that we have to understand as retail investors, and letting the bond market really guide us and show us like where are we going to end up going next. Because the bond market, that's quote unquote smart money. So what we're seeing here is we're seeing a lot of the shorter term interest rates continue to rise, which means that the institutions are actually selling that. And then you see a lot of yields of the 30 and the 20, and then even the 10-year yield, they continue to, the interest rates continue to lower, which means that they're actually buyers of that. So the problem with this is that that's actually showing that there may be some sort of economic disruption in the near future within the next 6 months to maybe 2 years. So in regards to this, the Fed is stuck between a rock and a hard place, right? So when you take a look at current inflation at this is headline inflation, right? 6.2%. But then you also have a slowing economy. So the economic growth is currently slowing. And then you also have inflation pressures. And then you have fuel that's just going absolutely crazy, most likely due to administrative policy. And then all of a sudden now you have what looks like to be a lot of asset bubbles going around the markets, not just the stock market, because you can take a look at the real estate market, the crypto market, and then even the stock market here, like what was it, 3 or 4 weeks ago, where you see Lucid and Rivian trading at obscene valuations when they haven't even sold a single car yet. Maybe they have some sort of pre-orders, but they haven't actually closed a deal, right? So you have these bubbles that are surfacing themselves. So the Fed has to do something about this. That means that they're going to taper, which would obviously decrease a lot of the asset prices in the stock market at first, right? But when the Fed does this, they also slow down economic growth, because there's actually going to be a portion of QE and how they do the QE in the first place. Because when the Treasury Department, when they actually end up selling their bonds, it's not the Fed that buys them. It's going to be a lot of the major banks like JP Morgan, Chase, US Bank. Those guys buy the Treasury bonds, and then those Treasury bonds are sold to the Fed from these major banks. And then that's essentially, so the Fed is actually going on the open market and they're buying these bonds. What ends up happening then is that actually decreases the interest rate yield, et cetera, right? When you get rid of that massive whale in the bond market, this essentially sends a trickle throughout the entire economic system that there's no more liquidity being pumped into it. Because when these banks have this liquidity, what they're more likely to do is they're more likely to lend out loans. When they're more likely to lend out loans, more people are likely to have access to credit. When more people have access to credit, that means they're going to be more buying in the economy, which spurs economic growth. So when they're going to stop this QE, you're going to start seeing contracting liquidity in the overall environment, which is going to, it should realistically slow down economic growth, because credit growth is slowing. So when you think about from an asset perspective, they have a problem over here because there's an asset bubble. And then from an economic perspective, they're most likely going to slow down, like our economy is most likely going to slow down. So essentially, and I think that Peru, we all follow Peru, right? He has like 200-something thousand followers. Essentially what he's saying is that the Fed is likely leading us towards a deflationary bust, because they're scared right now. They're scared because they need to figure out what the heck to do with the markets, because the markets are going full on euphoric, basically very, very close, dangerously close to the 1999 bubble levels. And then they also have not necessarily hyperinflation yet, but it's definitely getting there. So high inflationary environment, people are mad, consumers are mad, and then, prices of everything is going up, and then you got bubbles all over the place. So now what's ended up happening here is we are, honestly, nobody really knows. Nobody knows. So we're all stuck between a rock and a hard place, which is why you see these institutions hiding out large in a lot of these investments, and like these large cap investments like Apple, Microsoft. So what are we thinking about? What do we need to do? Number one thing is we have a couple different major catalysts. We're going to have our inflation data come out very, very soon. And that's going to be a very big sign here. And then we also have the Fed meeting coming up, and we're going to get a lot more clarification as to how 2022 is going to be handled. Is the Fed going to speed up asset purchases from 15 billion to 30 billion, or not necessarily speed up, slow down asset purchases from 15 billion to 30 billion? So they're going to decrease their overall bond purchases by $30 billion a month. They're currently doing 120 billion right now. And then this would likely spur off a major correction in the overall markets, essentially why we're getting what we're getting here today. So long-winded response, right? Number one thing to pay attention to is price action, right? The markets are going to correct. It's going to do what 2018 did. People did not necessarily know what to do until like a day. I think OPEX was that Friday, which is options expiration was that Friday. That Monday was the bottom of the 2018 market. It is kind of a crash, but it was kind of a correct. So when you see that massive follow-through day, these days are historically going to be good days to really debate on actually, starting your position. And then there's another telltale sign of a bottoming market is when you start seeing, so you can actually look at the bottom of the 2020 pandemic, when you start seeing aggressive moves back and forth, but they stay in a similar range. So you start seeing aggressive moves up and an aggressive move down, and then you see an aggressive move up and an aggressive move down. Look for something like a double bottom, right? These are just like technical indicators are really going to be a hardcore telltale sign of that we're very, very close to a market bottom.
Yeah, so everyone handles things differently, right? And Chet, I'll let you speak on this here in a second. Know yourself. Know if you're trying to be a long-term investor, and if you are, then there's nothing wrong with adding a better cost basis than what you were before. To Dylan's point, I would say pay attention to the macro and understand where we're at. But if you're investing in the long-term in quality companies and looking at the spots and checks of things that we've talked about earlier on the spaces, and you're holding 5 and 10 years, your likelihood of success will be much greater than waiting to get in and just never taking the plunge, right? And there's a lot of ways you can do that through dollar cost averaging and diversifying your portfolio. But I agree with everything that Dylan said there as well.
Yeah, I kind of agree, Dom, on part. But I foresee like few of the major macro catalysts which are coming up. Those are like kind of a bare thesis of mine. One is the clash of Democrats and Republicans over debt ceiling. I think that is going to, if they are not able to reach the consensus, US will default on the debt, and in that case, the US credit rating will be slashed, just like we saw in, I think, 2012 or 20. I don't remember on top of my head, but if that is a scenario in play, I think today's market sell-off is not related to what we are seeing for majorly the interest rate hike, or maybe for the increased tapering, right?
Sure.
So,
Yeah. Go ahead.
Those things are we are in definitely a tough macro environment, and my only kind of worry there is if this continues more, we may see our portfolios bleed a lot. Especially like personally, I am invested way too much in tech, and my exposure is way overexposed. Like I'm a big Palantir bull, and I have been like, it's one of my core positions. And to bleed every day $1, it's kind of hurts.
No, I mean, I agree with you. It's not fun. It's not
Yeah.
fun, and it's not easy. That's where you have to know yourself and your personal goals and what your money's used for and your time. If you have a time horizon where you're going to retire in the next 5 years, I would me personally, if it's me and it's 5 years before retirement, I'm going to be very well diversified in more conservative markets and maybe not even be all in full stocks. But that's where investing is very personal, and you have to know what your goals are and what you're trying to achieve. Like for me, I'm 37, right? Or turning 37 here in December. And I don't care what happens right now. Like tomorrow's not promised, but like my goal is for 20 years from now. So I'm trying to find the companies that I truly have conviction in, that I believe will be around 20 years from now. And I may not be right on all of them, but if I can be right 60% of the time, then that should yield some great returns for my family long term and for their family. So for me, I know what to expect it. I struggle with, well, you're right. We could actually go really much lower if they can't agree on the debt ceiling, and it could plunge even further. So we're not here giving, buying and selling advice. We don't know what's going to happen, but it definitely seems like prices are opportunistic. I would leave it at that.
Yeah, thanks, Dom. Thanks, Dylan.
Yeah, no
thanks,
problem.
Chet.
We have Luca. I know you've been waiting patiently there, so wanted to get your question, then also see if GFO is back ready to ask their question as we wrap up.
Yeah, hi guys. Can you hear me?
Gotcha.
Yes, sir.
Yeah, what's up, guys? First of all, thank you for hosting these spaces. Dom and Dylan, I follow you both, and I really enjoy your content. So, seeing the sell-off in growth stocks in the last couple of days, especially in the growth stocks which are not profitable, do you maybe think that the move in the right direction would be to find growth stocks with positive net margins? For example, PayPal has recently really sold off, but they're bringing money to the bottom line, or maybe Visa, or maybe MasterCard, or some other non-fintech growth company, but with positive net margins. For example, Trade Desk, I believe they have around 30% net margin positive. So, yeah, I would like to hear your opinion on that.
Dylan, you want to go first on this one?
Yeah. Obviously, nobody can tell you what to do with your portfolio from a historical perspective. The answer is yes, right? You want companies with a strong bottom line as well as a strong top line. So I think that a stock that I often talk about, that I still like, by the way, is Fubo. And Fubo has very poor operating margins, negative gross margins, and it's just losing cash aggressively. What I ended up doing is I actually ended up selling the stock, and I bought a couple options contracts to define my risk, right? That's the number one thing, is define your risk, right? There's nothing wrong with, if you got a money losing stock right now, I wouldn't necessarily hold it throughout this, because you're going to notice very, very quickly that the stocks that perform very, very strong are going to be the ones that are making money or have a very, very strong balance sheet. Like Confluent is going to be another stock that is performing very, very well throughout this entire sell-off. Pubmatic is going to be another stock that's doing that as well. And typically very profitable companies, they correct just a little bit less than the rest of the growth stocks that are out there. But then more importantly, they recover. So that's the number one thing to think about here is during market turbulence, it's sometimes, as investors, right? Because traders, 99% of the time, they're going to be out of the market. And I have a really good friend of mine right now who's a trader. And he's like, yeah, dude, I've been in cash for 3 weeks. I'm like, yeah, I don't blame you. And sometimes I wish that I would have done that, but I really do take a long-term investing mindset approach, because I'm more interested in allocating capital here at good valuations with great companies, right? That's my approach. But what I'm definitely thinking of here is what's going to happen after the market recovers. And in this particular case, the best companies with the strongest revenue growth and the balance sheets and the strongest margins are going to be the ones that recover quickly, rapidly, and then they may even hit new all-time highs.
Yeah, so go ahead, Chet.
Yeah, so I wanted to add a little bit of perspective from like the previous question and this one. It's mainly piggyback on what Dominic and Dylan have said. So what I do is I take my biggest position. You got to sit down for 10 minutes somewhere and decide what type of investment strategy you're using. Now, for me, that's easy because I'm like a pure fundamental driven person. I don't do any trading. I move out of positions usually. I have stop losses because I deal with small caps, but I'm usually purely fundamental driven. So in this case, what I do is whenever I see sell-offs like 5%, 10%, 20%, you got to know what you own. So what I own usually is SaaS businesses that have subscription-based economics, and those have pricing power, and those are resilient during recessions and stuff like that. So once you know what you own, for example, like if there is a rate taper going on right now, it's not really going to affect any SaaS businesses. And why is that? Because all SaaS businesses have pricing power. If you're a customer of Confluent or Datadog or CrowdStrike or any of these SaaS companies, and your life is dependent on it, your business is dependent on it, you're not going to leave them if they charge you like 5% extra. So all these companies usually have pricing power, and their business models are very resilient during like downturns. What happened during COVID 2020? All the stock market was down, but all the tech and SaaS-based businesses were going up. Why is that? Because fundamentally the business model supports the businesses during these times. Now, to Dylan's point about looking for profitability during these times, I totally agree with that, and that is why I'm like a growth at a reasonable price investor, where I look at the fundamentals and their operating margin. Now, basically, whenever a business runs, you need cash to invest in the business to grow. So where does that cash come from? If you have cash already on balance sheet, you'll use that, or you will have to issue more shares to get cash, which I absolutely hate. If any of my companies is doing that, I'm just going to sell off, because I don't like capital being raised by diluting my equity. And the third option is to raise debt, Now, in case of SaaS businesses, the debt situation is quite attractive because the rates are like 1 or 2%, and all the companies usually have a cost of capital of 3 to 4% at max for getting debt. Some really mature companies with high FCF, free cash flows like Dropbox, Datadog, and others can even charge a 0% coupon. That means that they are getting the money for free, basically, based on their fundamentals. So that's how you can fund your business for growth. Now, what happens when interest rates rises is that the cost of capital or coupon rate will go a little bit up. Now, if your business fundamentally grows at 30% or 40% every year, and your cost of capital goes up from like 2% to 4%, how much does it matter? You're compounding still at a high clip, and it's not going to fundamentally affect your business if you're funding your business through cash or debt, either way. Unless like the debt goes to like 8, 10%, then it's going to like kill your business. But otherwise, I don't think there is going to be any problem. And if you're using debt, you need to have some cash or some positive operating cash flows, because in a situation where you have no debt available, you want the business to still run, right? You want the business to still grow. So your business should generate enough cash flow to fund yourself for the next 2 years. A really good example of this is Netflix. Netflix has reached a point where they generate enough cash flow, probably like $14 billion every year, that they can reinvest in their business and never take any debt. They can grow at a massive world, like global scale. They have enough cash flow to fund their operations every year from their revenue that falls down to the bottom line. So that's how you should look at these things. And generally, I don't really care about macros, because if my fundamental quality investing decisions are right, all these things are taken care by the managers who are managing the business for me. Like, for example, if it was Palantir, Alex Karp, Peter Thiel, and all these guys are managing these things for me. I don't really have to bother with this. So that's how I look at these things.
Yeah, I'll wrap us up here. I know we're a little over the hour. I want to be very respectful of everyone's time, and then we'll just, everyone can give a final thought here with Dylan and Chet. Both guys are right when it comes to the fact of more cash on hand with positive net margins, profit margins in hand are going to be able to sustain market crashes and turbulence. That is very true. And in the long haul, that can really pay off. What I would say, and I think they would agree with me, is it's all personal. And what I mean by that is that based on your time horizon, based on what you're trying to achieve, and based on what you're passionate and will follow and will hold those stocks long term, that's what you should be in my opinion, right? So if you're going PayPal just because it's more stable and it's not gonna fall through and they have cash on hand, I mean, yeah, if you're a trader and you're a swing trader and you bounce all around and that's you, then that's you. That works out great. If you're a long-term investor and you're looking to hold things, like me and Dylan operate a lot differently from that perspective, in that I won't sell through the crash. Like we go 20% down, I will find more cash to add to. And I just won't bounce around because I'm not good with technicals. I'm not good with macros. I'm not an economics major. I just know the companies that I feel I have the most conviction with, that I do the most hours of research on, and that I work in SaaS enterprise sales as well in cybersecurity, so I understand that business. But for me, it's just more of trying to lower the cost basis, trying to stay in tune with where the company's going, and keep building that. And then I do look at, okay, companies like Digital Turbine, they have a net profit margin, I want to say, of like close to 30%. Same with the Trade Desk. The Trade Desk is my third biggest holding. Net big profits margins with NVIDIA. So that is a component that I look at, but I'm not going to run into a stock just because of that to endure. Some people believe in just enduring with things that will do well during this time and then get out of them. I'm not good enough in and out of positions constantly. So I'd rather just know these are the companies I'm going to hold for the next 20 years, whatever it may be. And if my thesis gets broken, like I sold out of PayPal. PayPal was actually one of my companies that I had, and I sold out 6 months, closer to a year ago, somewhere in that time frame, because my thesis on Palantir and my conviction on Palantir was so much higher from the growth rate and the capabilities that that company could do, that I wanted to use that capital towards Palantir. So if there's a better opportunity cost, then I'm going to do that. But very rarely do I sell out of any stock at all. I'm still holding all the red that I have from all the cannabis I invested in back in 2019 at the height of the bubble. So, but we'll let everyone just kind of have a final thought. I really appreciate, I see some awesome FinTwit followers that follows out there too, like Richard Moglin and Disruptor. So we'll definitely do this more often, because as you guys know, or if you don't know, both me and Dylan are trying to start our own YouTube channels. I have the podcast. I'm fully solo, still friends with everyone at Pounding the Table, but doing things solo with Dominating Your Investments. So you can catch the podcast there on any of your platforms, as well as the YouTube channel. This will be on the YouTube channel and podcast as well. So give us a follow, listen there. And then, and Dylan, I want to have you give your final thought, and make sure to go to his YouTube channel as well, Blue Suit Dylan. He does excellent work. So Dylan, what are your final thoughts for this week and headed into next?
Yeah, as far as this week goes, it doesn't look like we're going to be close to a market bottom. I think that there's been a lot of signs that there's going to be further weakness. I mean, the number one thing to really think about here, in my perspective, is just to make sure you're defining your risk. I know that there is it is smart to do long-term investing for quality companies over time, but you don't know what you don't know, right? And that's the number one thing that I always look at it as is there's no nobility in poverty, right? It's just try not to lose money out there. Make sure to pay attention to what's going on. Don't be afraid to test your thesis. For example, I really like Global E, and I really like DLO. Those are two of my favorite companies that IPO'd this year. I continue to add to those because I got a high conviction. So if you have a high conviction in the stock, because you do think that it's going to produce great investor returns over years, that's something that's going to be completely different than buying the next biotech stock that you think that might be able to, cure cancer or change the world, right? Because they usually don't necessarily they're not necessarily making any money. And defining your risk and making sure you protect your capital is going to be one of the most important things during this time. And I'm not sure if you guys have ever seen that chart floating around here, where if you miss the 10 worst days in the markets over the past 10 years, you drastically outperform the S&P 500. So that's definitely something to think about when I say just protect your downside risk.
Chet, what are your last words for the week and going into next week? Can't hear you. I don't know if you're on double mute.
Can you hear me now?
There you go. We got you.
Oh,
now.
cool. Yeah. So for me, generally, I'm like a very long-term investor. Thankfully, like probably Dominic, I'm really early in my life when I discovered fundamental investing. I'm still 29. So my perspective is like to live for 30 years and to ride my investments for 30 years. So I'm looking for always long-term investments that are fundamentally driven to grow rapidly over 10 or 20 years. I would say I don't really look at these daily or weekly movements at all. It works for some people. It just doesn't fit with my nature and my personality. So I sat down for a day, wrote all my values, and I matched my value system with the things I want to do. And at the end of my analysis, I came up with that long-term investing was efficient, sustainable, and matched with my personality and my goals for like building capital over 20-30 years. So I don't really look at daily, weekly, or even monthly or quarterly movements. For me, the game is a very long game. And if you're familiar with some of the longer format of games, think of it as like instead of a couple of hours of game, it's like a 5-day or 10-day or a yearly game that I'm playing. And for me, it's generally the time is in like 5 years or in decades.
I love it. I love it, Chet. Um, so I'll wrap us up here. I really do appreciate everyone who either joined or stayed on the whole time. Appreciate Chet, you coming on and all the questions too. We're all in this together, right? This is investing. We're on here for a reason because we like talking about stocks. We want to make generational wealth and provide for our families and for ourselves and live a different lifestyle and retire earlier so we can do what we truly want with our time and our careers. So, I'm along for anyone knows who follows me and listens to the podcast. Today, I look at as an opportunity. Is it going to probably be a better price than I just spent a whole bunch of money on today? Yeah, but it's all right because I know long term that was still much better value than what I owned previously for some of the stocks that I have very high conviction on. Great leadership, great company cultures, and I'm going to reassess my thesis on everything that I'm maybe not as excited about and see, are they still intact? Are they still executing to why I invested in that? Having an investing journal is a great idea. If you haven't done that, it's a great reason to just every time you buy a share, just type a note or write a note. Why did you buy the company in the first place? What was your thesis? Why were you compelled to do that? And to look back and go do that, and then see if that thesis is still intact. That will help you hold conviction. That will help you prioritize what companies you want to hold long term, and you know yourself better than anyone else. Like I can't tell you, what to buy, what to sell, what to trade, when to be in, when to be out. You know your retirement, your goals. So don't trust anyone on Twitter for that. You know what you want to achieve, but you can also get a lot of great research, great lessons learned, and an investing education really on FinTwit from a lot of different capacities. So I think next week, it could go higher, it could go lower. I can't predict the market, but what I can say is there's a lot of great innovative companies that are changing how we do life, especially around data and compute. I don't think those are things that are going away by any means, but only growing exponentially. So that's why I invest in technology and healthcare. So thank you again, everyone. I'll put this on the podcast. I'll put this on the YouTube channel, and probably be doing a lot more of these ad hoc because I really want to talk more about stocks with other people and answer questions and ask questions myself. So thank you, and we'll talk again soon.
Thank you, Dom.